I'll just quickly run through the agenda for the day. We will start with the introduction and overview of EV financing in India by Ms. Nehal Gupta. And it will be followed by a talk with Mr. Sameer Aggarwal on the use of technology in facilitating EV financing and impact made through EV financing. And after that, we have a panel discussion on navigating the challenges in India's electric three-wheeler financing space specifically, with Mr. Dhiraj Agrawal, Mr. Rajat Goyal, Mr. Ashok Mittal, Ms. Nehal Gupta, and Ms. Vani Rikhi. And this will be followed with a quick question and answer round. So during the course of the webinar, if you have any questions for our panelists, please feel free to put them in the Q&A box. The panelists have an option to either respond to you on the Q&A box itself, or we can take some of the question towards the end during the Q&A session. So without any delay, let me just welcome the first speaker of the day. Nehal, over to you. You can share your screen now.
Thank you so much, Priyakshi, and thank you for the opportunity. Very excited to get started. I will just share my screen. Please let me know if you can see my screen.
Yes, Nehal, is it full screen?
This is full screen, yes.
Okay, yeah, go ahead, please.
Great. So the agenda, like Priyakshi already mentioned, is to understand the EV market and the EV financing market in India and the overview of what is the market size like, who are the stakeholders in the entire electric mobility ecosystem, what is the lending overview like, what are the challenges with the lending and from different stakeholders in the ecosystem, the role of the government, and would like to humbly introduce AMU Leasing after. So to begin with, first, a very generic overview of why India needs to shift its mobility. As we all know, all the EV enthusiasts here in the panel and all the attendees understand that 19 out of 20 warmest years have happened in the 21st century due to global warming. India is ranked as the 5th most polluted country in the world and has also committed certain carbon emission reductions by 33 to 35% in its GDP. So there's a huge need and demand to shift from low carbon or high carbon technology to electric mobility, be it powered through batteries or solar powered or hydro powered, whatever emerging technologies are now coming in this space. Why electric vehicles are a value addition in the ecosystem is because of 4 major reasons. First is the public health. Of course, because of reduced carbon emissions, we can expect improved public health overall across the country and globally. Enhanced energy securities in terms of whatever dent it gives to the fiscal deficit due to oil imports that we do. So I think removing oil as the major source of power within the transportation fleet can significantly help reduce those fiscal deficits and save money on the oil import. Third is the total cost of ownership of electric vehicles, which we obviously know is about 2 to 3 times higher than an ICE vehicle. And that total cost of ownership savings and operational cost savings can further lead to livelihood generation potential for those users, the end users of EVs, through healthcare, education, food, housing, and uplifting their lifestyle overall. And fourth, and the largest one, is job generation. So while we add a new technology and a product into the ecosystem and our economy, there's a huge revenue and job generation avenue that it's created through that. So through fleet electrification, through ride hailing and delivery services that have seen a huge surge in urban and semi-urban market, and indigenous manufacturing, by adding in more manufacturing facilities to be able to produce and manufacture these vehicles, will definitely add into more job generations, which again leads to livelihood generation potential. Now, when we talk about electric vision for India by 2030, what does it really mean? What does the government want to promote? So we see that out of the 25 crore anticipated units of vehicles by 2030, 10.2 out of the 25 crores would be electric vehicles, which translates to about 40%, which is a huge number of electrification of the fleet by 2030. And if we see it segment-wise, you can see commercial vehicles and two-wheelers and three-wheelers pose the largest demand and the surge in the electric vehicles. So 70% of all commercial vehicles by 2030 would be electrified, and 80% of all two-wheelers and three-wheelers would be electrified according to the vision that the government, Indian government has set for the country. So this definitely poses a huge, huge opportunity for all the ecosystem stakeholders, from lenders to manufacturers to the users. And if we look at the current adoption, it's already 10% above the vision that we had envisioned for say 2022 or 2023 or up to 2025. So there's already been a lot of buzz around EVs, and people have very positively adapted to a newer technology that has come in the market. Now, if we talk about in terms of financing, how big the market size is for electric vehicles, we anticipate a 40,000 crore market size. And because of how large this market can become and the kind of sections of society it treats, RBI has already begun considering electric vehicles under the priority sector lending. So it's not approved, but it's in the talks, it's in the discussions and debates for how and why electric vehicles should be included in the priority sector lending. So why they would include EVs in the priority sector lending is because of the four major reasons that you can see. First is the stakeholder acceptability. How well are all the stakeholders in the ecosystem adapting the product and the technology? How well are they able to support the assets that we are trying to finance and bring into the market? How well are those assets able to support to the weaker sections of the society? What is the livelihood generation potential? Like I just mentioned, is it able to support the more rural and semi-urban market and able to generate the employments like we envision it to? What is the scalability potential of the product? Can it be adopted on a mass level? Will it be able to support those urban and rural current situations in India, and how well those will be accepted by the people using the asset? And the techno-economic aspect of it, which is obviously the costs related to the procurement of vehicle, to lending the vehicle, to to set up the entire ecosystem for the vehicle to run smoothly. We have to look at these 3 to 4 factors, and RBI is now, it's a very hot market debate for it to be considered in the PSL for the lenders and to reduce their costs of funds as well. Now, when we talk about the electric ecosystem and the financing within the ecosystem, who are the main stakeholders that we're talking about? So first, as we all know, the first point of contact is your original equipment manufacturers or OEMs. So these are the people or companies that procure all the parts, manufacture the parts, and produce the vehicle in the market. And in the current scenario, we see that the prominent segments are 2, 3, and 4-wheelers that have seen a major surge, and followed by smaller and relatively smaller share of buses, tractors, and trucks and other modes of transportations, which are gradually following. But largely, we would see 2, 3, and 4-wheelers bursting out in the market. Second, and one of the most important stakeholders are the mobility players. So this group includes dealerships for individual customers. It includes logistic players, fleet operators, government fleets, secondary market players. And this is the set of players that is actually seeking financing and leasing from lenders. So OEMs are never seeking the money. They're never taking the money. It's the mobility players that seek the finance. So this is where the real money outflow is. And these people are very well versed with the market. They're already ahead of everyone else in terms of technology, in terms of financing, in terms of exploring different options. And they have hybrid models with multiple lenders, including even banks. And they seek funding mostly in form of either financing or leasing for individual units, or also for inventory funding and trade advances to be able to procure those vehicles from OEMs in a large bulk deal. And then the third stakeholder, the set of stakeholders is your charging infrastructure and battery as a service models. So now we see that battery swapping or battery as a service has been an emerging model, and people have been willing to adopt that model. And there's also a fixed battery model, which has also already been running in the market. So by supporting battery swapping infrastructure or by supporting the charging infrastructure in tandem with the vehicles is extremely important, because the electric vehicle can't be on the road in silos. It has to be supported by the ecosystem and the value chain partners like charging and swapping. So these people play an important role, and how financing plays a role in this segment is through battery leasing, battery financing, if it's not a fixed battery, battery top-up schemes or battery refinancing, wherein you require a newer battery post the tenure of your lease or loan, and the debt or capex required to install charging or swapping stations, wherein lenders can also play a part in helping companies install these kind of charging infrastructures. And the fourth a stakeholder is the retail customer, which is the end individual user who's driving the vehicle for their personal use or for driving the passengers. Now, let's take a look at who are the different types of lenders. So on my left, you see our banks, and on the right, you see our Nbfcs. So these are the two prominent lenders in the market who have the license to lend. And then further, they partner with different kinds of fintech companies that have made a digital platform for ease of customer acquisition and dealing with a larger customer base. So there are multiple hybrid models that lenders choose. Banks can choose to co-lend with other banks, with other NBFCs, with other fintechs. And similarly, NBFCs can choose to co-lend with other NBFCs, with other banks and fintechs. And there's a bunch of permutations and combinations that you can find today in the market, where lenders have a lot of dynamic different approaches, where there's no one size fits all. You know, there's different customer requirements, and that requires different models to be taken care of. Now, when I talk about the lending models with the type of lenders that I just mentioned, there are two typical models that we look at. So on my left, there's a hire purchase retail model, which means that it is a traditional sort of loan agreement for your retail customer, which is an individual person. So you see there's a lender. The money is flown from the lender to the dealer or the super stockist who's keeping the vehicles. They procure the outflow, the money, and they then exchange the asset against that money acquired from the lender to the customer. And the customer is ultimately responsible to repay my EMIs in form of monthly payments or daily payments to the lender. So this is a traditional loan agreement or a financing agreement within a retail segment. And if I talk about the enterprise segment, I would say that financing is now evaporating from the system. People are trying to adopt more leasing because everyone wants to be asset light and no one wants to take the onus of owning the asset pool company. But I have, for reference, given a very simple, straight up model of what an actual typical leasing looks like, where there's a lender. The money is flown from the lender to a fleet operator or a third-party logistics player who's responsible for aggregating the vehicles and running the vehicles. Those people book the assets on their books in a typical state. And then further, that asset is subject to contracts with e-commerce companies like Amazon, Flipkart, Big Basket, or FMCG companies, or government contracts, because this party, the e-commerce companies or FMCG companies, are very reluctant to put the assets on their books. So they would want to deal with an operating lease model. And then that revenue generation source from these vehicles is then arranged into an escrow account, which people like lenders, fleet operators, and e-commerce companies are part of. So whatever revenue is generated from this segment goes into the escrow, and usually the lender has the first charge right to charge their rental income or EMI, whatever it may be, depending on the arrangement, through this escrow account, and then the charges are further deliberated between the other parties. So this is a typical leasing model, but there are also a lot of variations within this model that we don't have the time to look into at the moment, but this is a typical model, and these are the parties involved in a leasing model. Now, when I talk about enterprise customers and retail customers, who are these people? Who are these companies? And what kind of characteristics do they bring on the table? So if we talk about the enterprise customer, these are usually newly or heavily funded startups or legacy MNCs that have been in the mobility sector for a very long time. These people are able to provide a much better credit worthiness compared to my retail customer, because they have been part of the formal banking system for a long time, and they are very aware and very hands-on with the technology, with the product, with their connections, leveraging the banking network, financial institutional network. So they come with a very different background, and they know what they want. They're usually covering the urban and semi-urban markets because that's where most of the e-commerce demand is realized. And they are the technology creators and curators. So all the route mapping for the vehicle, maximizing the efficiency of the vehicle is done through these companies and the technologies that are provided by these companies. And a typical retail customer is an individual customer who uses the electric vehicle, especially the three-wheeler, for primary revenue generation of between 15,000 rupees to 25,000 rupees monthly, which is approximately 1.5 to 2 times of what they would be otherwise earning if they did not have a vehicle. They have moderate awareness about EVs and its benefits, and it's usually through word of mouth within their tier 2, tier 3 cities, because for example, if I talk about electric rickshaws are on a rise, so those people would know how much an electric rickshaw driver would earn, and what the electric vehicle entails, how long the vehicle will run for, etc. They are low to credit age or come with no credit age at all. That meaning that they have not, most of them have not been part of the formal credit or banking system, meaning they've never taken or procured a formal loan from a bank. So these people are most of them are purely unaware on what lending is, what financing is, what an EMI is. So there's a lot of customer awareness that goes with this segment of customers. And because they come from rural areas where there's lack of digital penetration, there's a very cash heavy mindset within this set of people. So if I say that one person is driving an e-rickshaw, the person that they're driving in the e-rickshaw is also paying them in cash. Then they are earning that money in cash and then further paying the EMI to financial institutions in cash. So it's a very hard cash cycle that is not broken despite the adoptability of smartphones, despite the adoptability of UPI systems, because the customer mindset overall is not as seasoned as we would like them to be. So this is the main difference between enterprise and retail customers. Now, overall, within the EV financing ecosystem, we foresee 3 main challenges. First is from the technology and the manufacturer, meaning that we understand that it's a very nascent technology that is still emerging, that is still gaining traction in the market. But there's a lot of uncertainty around the technology and the product, because most of us have not experienced that product on road for the time they say it would be on the road, for the times that OEMs claim it would be on road. So largely, lenders have had a problem understanding the technology, which is why it restricts their confidence to move freely into the market and give higher exposures. Policy challenge in terms of how the government has heavily subsidized the industry and incentivized the industry. We are not sure of how well your margins will be for the OEMs or for the lenders if those incentives and subsidies are retracted. How well am I going to be able to perform in the market? Will there be cost reduction in the auto components that we foresee? For example, making the batteries cheaper, because until those costs are reduced, we can't function as an industry without the policies that are currently set for the country. And third, and the largest challenge, I would say, is the lack of secondary market or resale challenge, where lenders, from a lender's point of view, strictly, we don't know the resale value of the vehicle. What are the metrics or the parameters on which you can evaluate the cost or the price of the vehicle post the tenure of 3 years, 4 years, or 5 years? So that poses a huge challenge. To be able to largely, expose yourself to the financial risks for these newer OEMs or for newer technology products. And what solutions we propose with the discussed challenges is, first, industry-led buyback programs, I think, will really help lenders assure of the product and where the product is going. And we see that if large 5 to 6 to 10 OEMs say engage in buyback programs, then that will also help regulate the market as a whole to to fix the parameters and regulate the parameters of how to go about reselling an EV, what to do with the battery, what will happen with the battery, how will the battery be refinanced, how will the vehicle be refinanced. So there are a lot of questions there which still need to be solved. That also pertains to the resale value again, and how to parameterize and put it down on paper for what metrics you're to look at when you're setting up a resale value. And I think large OEMs can definitely help us with that. And third, like I mentioned, is risk sharing mechanisms with other banks, NBFCs, larger international banks, through co-lending mechanisms, through subventions, where you are able to create a strong enough risk pool account to mitigate your risks and diversify your risks among many other players. Now, as an NBFC or as a lender, as a bank, the core expertise that you need is getting your payments back, getting your money back. So there's a huge manpower cost and operational cost that goes into collecting the money back. No matter how hard we try to penetrate this market, especially the rural market and the semi-urban market with technology, specifically for collections, it does not always work. The customer does not always know how to use the technology very well. So we need to have manpower, we need to have field agents, which definitely shoots up our operating costs to be higher. And while you, through sustained relationships with those customers, you can make them aware, but to create that awareness, customer awareness, to generate that awareness, it requires time. So you're halfway through your loan tenure when the customer actually starts to understand what technology is, how they can repay through different merchant banks, through UPI, through bank transfers, barring cash, what other avenues can be used to make the timely payments. Because timely EMI collection within softer buckets, meaning within 30 days or within 60 days, is a challenge, especially within cash intensive markets. So these are the major challenges within collections that we foresee, where technology does play an important role, but also not entirely. So no matter how lean you want your operations to be, there are still some loopholes there where you need your manpower, you need those kind of agents who can help track the customer, make a relationship with the customer, and help them get awareness on how to repay the money back to the lender. And how do we foresee the government's role in this is, again, like I mentioned, first loss default guarantees, if they're able to provide with larger international banks who have funds to spare for renewable energy and green energy, if those kind of larger banks or the government are able to share the risk with us, the smaller lenders who are trying to get into this space, will be really helpful. Creating a sub-target for EVs within PSUs, where the banks have a clear mandate on what is their target and they have clarity on how much they can lend, can also help regularize the market. I think interest-free loans for large empaneled OEMs, meaning OEMs that have created a legacy in the market, that have an assured product quality, can also be given loans on interest-free loans, meaning provide them loans without any interest to gather more adoptability of the product and to, again, regularize the market. So overall, these programs and these schemes can help with the credit access and money flow and liquidity for electric vehicle ecosystem, and not just the vehicles, but also the charging infrastructure around it, the battery infrastructure around it as a whole. Now, let me just take a quick moment to introduce what AMU Leasing is and what we do. So we are a Delhi-based tech-enabled NBFC, and we are an EV ecosystem exclusive NBFC. When I say that, I mean that we are not dealing with any sort of ICE vehicles or commercial vehicles. We are only trying to boost the electric vehicle ecosystem in the country. And by electric vehicle ecosystem, I mean not just the vehicle, but the charging infrastructure that comes with it, like I was mentioning, and supporting all the value chain players within the full ecosystem. We have approximately 350 plus clients as of now, touching 500 by the end of this month. We have generated about 30 crore rupees for our end users, given how much they are earning per month, into the number of clients we have, into the number of months they take the loan for us from. and how long that vehicle can last for. The longevity of the vehicle is about 5 to 7 years. So if they're able to use that vehicle that we financed for them and generate that sort of revenue, that translates to about 300 to 400 million rupees. And our current portfolio, product portfolio consists of 80% retail and 20% corporate. And 20% is a smaller number for now because the L5 category is still emerging in the market. The corporate deals are still emerging in the market. We've seen some dip supply snags and issues in the past. And retail in the L3 market has been on a spurge for sure. We're live in 6 states, Delhi, NCR, Haryana, UP, Karnataka, Telangana, and Maharashtra. We've experienced a 40% month-on-month sales growth last month. And that was due to, I think, the fading away of pandemic characteristics. We have seen people coming in now, people having enough income to be able to pay for down payments and lease the vehicles, finance the vehicles. So there's a huge demand there. And our current NPA, net NPA is about 0.5%. We understand our books are really small, but we've tried to contain the defaults at our best. Why AMU? Like I mentioned, we are doing both enterprise and retail segments. We are covering all the hot markets in the country within the north and the south. We are serving no credit age to low credit age customers, and our disbursement process is very lean, and we commit to under 72-hour disbursement to our customers, subject to all the terms and conditions that are completed. Our current associations include both L3, L5 mobility players and battery as a service players, which are still in the pipeline that I can't disclose the names of. But Atul Lohiya Sarthi within the L3 community that is now popping into L5 as well. We have Euler, Kinetic Green within the L5 segment, and then Moving and Old as part of our logistics partners, and more battery as service players in the pipeline. And we aim to finance about 1 million vehicles by the end of 2026. So that is our goal. And yeah, that's about it. This is just a synopsis of all the customers we've dealt with and the smiles we've created across our journey. Thank you.
Actually, you're on mute.
Oh, thank you. Yes, I just realized. Thank you, Nehal. It was a very comprehensive presentation, very insightful. Thank you for all the work you put into making this. Thank you.
Thank you. Thank you. Hopefully I was helpful.
Yes, yes, it was very good. Now let me invite Mr. Sameer Agrawal from RevFin to present on his topic on the use of technology and the impact creation through EV financing.
Hi, good afternoon, everybody. And actually, thank you for inviting us. And Nehal, also thank you to you because your presentation was very comprehensive. So it makes my job very easy actually now.
Thank you. Thank you.
Let me just share my screen. All right. Okay, so I'm going to talk a bit about how EV financing can be done with use of technology and what impact can it therefore create. Now, RevFin is a lending company, so we provide loans to people, to individuals, to buy electric vehicles. But even though we are a lending company, we use a lot of technology to make our decisions and to manage customers. And because the customers themselves, a lot of our customers are near bottom of the pyramid or subprime, therefore there's a lot of opportunity to use technology to underwrite such customers. And I'll talk about it as we speak today. And we've created a method in which we can actually get the customer to apply for a loan and get a dispatch order in less than 16 minutes. Right? So that's the kind of impact we have created through technology. And I'll be talking about that in a few minutes. But before I do that, let me just talk a little bit about challenges of EV financing. And Nehal has already spoken about them, so I won't spend too much time on these challenges. So from our perspective, obviously there are very few lenders in the market for financing electric vehicles. And there are various reasons for that, and we also feel some of these reasons. So first is obviously that the product is unproven. These are still new products in the market, new technologies, evolving technologies, newer technologies coming in very quickly. Therefore, it creates a lot of uncertainty from a financer's perspective to finance these products, especially given the range of the products, the life of the products, and resale value, etc. The second, the market is very unstructured even today. And if you think of it, the most popular category of electric vehicles is three-wheelers. And in that segment, certainly the market is extremely unstructured. You go to small towns in India, tier 2, tier 3, tier 4 towns, and you suddenly find hundreds of dealerships selling 1 or 2 or 3 vehicles a month. And you realize the market is so fragmented, so unstructured. It's very difficult to actually identify what players you want to work with, what OEMs, what dealers you want to work with, and which ones you don't want to work with. The third one is I would say the usual suspect, no secondary market. I think that's the excuse that everybody uses for not financing electric vehicles, that there isn't a secondary market. Well, the primary market has just started, so the secondary market will also obviously develop over a period of time. And as Nehal also pointed out, there are quite a few different ways by which you can reduce the risk of secondary markets, like buyback and things like that. And finally, customer is credit unworthy. Certainly in the three-wheeler segment, but also in the delivery two-wheeler segment and fleets, etc., the customer is largely credit unworthy. And just to kind of build on that point, I'll just share some metrics with you. 81% of the applications that we receive are from financially excluded people. And I'm just looking at that on the basis of having no credit scores and having no income, or an income that they are not able to prove. Right? And we find over 40% of our customers come to us with no credit scores. And the process or the technology we've created helps us underwrite such customers. And we are able to, even with customers with no credit scores, we are able to approve about 82% of those. Right? So that's just to shed some perspective in terms of what type of customers come in. Because ultimately, as a financial institution, our main objective is to underwrite customers. So now the question is, keeping in mind all these challenges, the type of customers, etc., why electric vehicles? And I think there are a lot of reasons why electric vehicles don't work. And what I will try to do is I will try to explain those reasons, showing the impact that those reasons have had on RevFin as an organization. So the first reason why we believe electric vehicles are a very good opportunity for lenders is because of scale. Of course, we've seen in the last 12 to 15 months that electric vehicle sales have increased significantly. But even for us as an organization, we have seen 30x growth in monthly disbursements in the last 14 months. Right? So that is the level of opportunity that exists in the market today. And I'm sure there are a lot of other panelists today as well, working in organizations or running organizations that finance electric vehicles. They would also be experiencing similar type of growth and scale. Right? So one is, it's a huge opportunity, huge scale. And I think there was a number that Nehal had put out. I believe the number is going to be much, much higher than that number as well in the next few years. The second is, it's a very secure business. Right? Ultimately, we are financing vehicles. These vehicles are hypothecated. These vehicles are being used primarily, at least in our case, for a commercial purpose, therefore income generation as well. So livelihoods of people depend on these vehicles. So taking away these vehicles is not, people don't want to give up those vehicles and they want to continue paying their installments. And linked to that is the fact that the customers are also get to earn a lot more. So the socio-economic impact of these vehicles is very huge. What we find is a typical customer of ours who's buying an electric three-wheeler, low-speed electric three-wheeler, their monthly income goes up by almost 2.5 times compared to whatever they were doing previously. Most of them were not driving previously. They were in some other profession, but their income certainly goes up by about 2.5 times. Even if that is not the case, in most cases, you would see that the net earnings of the driver, either because of higher income or because of additional cost saving, the net income actually goes up using electric vehicles. So there's a very strong case for that as well, that actually it improves affordability or ability of the customers to repay. Finally, saving the environment. And this basically just shows the distance driven by the drivers that we have financed cumulatively over the years. And our drivers have now driven over 130 million kilometers, which has a huge impact on the environment and vehicular emissions. Right, so these are broadly the reasons why we like to focus on electric vehicles as an organization. Now the question is that how do we make electric vehicles work for financiers? And the simple answer to that is by creating ecosystems. What we do as an organization is, first of all, we are a completely digital lending. We've got a complete digital, 100% digital lending process. We use a lot of non-traditional methods for underwriting because the customer, as I said, is credit unworthy. So we make use of biometrics, psychometrics, gamification, telematics to make our lending decisions, as well as to manage their accounts. And finally, there's a lot of ecosystem development, which means we partner with various different organizations to ensure that the risks associated with the product and with the customer can be reduced significantly. Now, how do we use technology? So as I was saying, ultimately, so what we've done is we've got a digital lending platform, and basically a customer, and whoever that customer may be, wherever they may be, they can download our app and apply for a loan. The whole process, we've created the process, and it's a very, very simple process, and it's just got tabs in it. So it's not that customers need to be highly educated or literate or have understanding of English, etc., to basically go through the process. It's a very simple tab-based process. Takes a few minutes to do, wherein a customer can basically download the app, apply for a loan, get a decision, sign their documentation, set up their repayments, and get a dispatch order issued to their dealers. And all of that can happen in our system in 16 minutes. In fact, last week we had a customer who completed the whole process in 12 minutes. We've at the moment we offer a bilingual language support as well, and hopefully in future we'll do more languages as well as we move into other geographies. Now, how do we make decisions so quickly and effectively? We use first of all we use biometrics, wherein we capture videos of customers. We do face matching on their videos. We with their government issued ID cards. We do voice recording, voice matching for customers to establish identity and fraud checks. We conduct a psychometric assessment on all our users to understand intention to repay. And in my opinion, with this, with the segment of customers, intention is the most important thing, because ability is anyway created by the vehicle that we are financing. And then we would also do everything that any traditional lender would do. So any KYC checks, looking at their credit bureau information, etc., banking transaction data, all of that we also do, but I won't go into much into that. As I said, most of our customers don't actually have all this information, and therefore we have to use alternative techniques. And we have, because of the techniques that we've created, we're able to have an approval rate of almost 90% for customers who even don't have credit scores. And yet we are able to maintain our NPAs at a very low level. So our net NPAs remain below 1% at the moment. Then once a customer is onboarded, what we do is we embed all the vehicles with telematics. As an organization, we receive 560 million data points about the vehicles that we financed every month. We are able to use this information very effectively to improve productivity, enhance the performance of the drivers, which means helping them drive a little bit more than what they did previously, which helps them increase their income, earnings, and hence the ability to repay. Obviously, telematics also helps in keeping the vehicles safe. We've helped a lot of customers recover their stolen vehicles so far. We are also able to provide feedback to OEMs, to dealerships on performance of their vehicles. And of course, it's a great way to improve collections by setting up early warning triggers. Things like if a customer has not been driving their vehicle for a few days, then they are therefore unlikely to repay their EMI this month because they won't be earning this month, right? So that's how we use telematics. We also do a lot of gamification on the customers, which means we basically incentivize customers to repay on time and to repay through digital means. Nehal spoke about this, that it's not very easy to fully convert collections to digital, and it is a big challenge. But our gamification platform is helping us improve that by incentivizing customers to pay digitally. Okay. Moving on, and then finally about building ecosystems. These are all our ecosystem partners. We partner with fleet operators, with manufacturers, with lending institutions, with insurance companies, and so on and so forth, with technology providers, to make sure that the driver has everything that he needs to keep his vehicle running. Right, and ultimately the idea is that whether it availability of spares, servicing of vehicles to ensure uptime and upkeep of the vehicle, whatever it is, we ensure that we provide all of that to the drivers. We haven't done that very extensively, but the idea is also now to start thinking about their charging, swapping, and all the other needs that drivers may have. And with fleet aggregators, obviously, it also helps them generate more income and a more, I would say, more consistent, getting income in a more consistent manner as well. Okay, so.
Thank you, Sameer. Thank you so much for that presentation. Very informative. So I will quickly, so there are a lot of questions coming on chat and Q&A. I would request the audience members to please direct all your questions in the Q&A box so that panelists have a clear segregated view of the questions, and we can pick those questions towards the end. Now we will start with the panel discussion. And for the panel discussion, the topic is navigating challenges and opportunities in India's electric three-wheeler financing space. Because three-wheelers, as everybody, I'm sure on the panel and of course our audience members know, are the, in terms of adoption, three-wheelers have taken a major leap. And if you look at the sales of recent months, according to Vahan data, the number of electric vehicles in this category being sold is more than the ICE vehicles. So that's a big, big win for electric vehicles. So we will sort of focus this panel discussion on three-wheeler financing. And I will start with Mr. Dhiraj Agrawal and try to get his views on how he sees the government's role and efforts in solving EV financing. What are his initial views on it?
Yeah, I thank EVreporter team and thanks for the panelists. I think Sameer and Nehal have already discussed in great extent. But yeah, coming to my question regarding the government, if you see the government of India is really doing good job. And
I'm sorry, sir, your voice is a little broken.
Now it is coming, right?
Better, yeah.
Yeah. So if you see today the government, major talk, if you talk of Indian government, we have now everybody knows that there is a FAME subsidy which is being given. So that is helping us, and the amount is really big. It is 10,000 crores, which is for the boosting of the electric mobility. Out of that, they are also bringing in some 1,000 crore for setting up a charging stations. That way, Indian government is pushing the this to the part, and other part which I think government should look on 2-3 things more because of supporting of the OEMs. I think mostly there is since so many OEMs are coming in, so if we start giving some subsidies on the land for the OEMs, that will definitely going to help these OEMs in initial setting up this business. And above all, there are 3 things which I feel is very important from the government point of view, rather which will help to increase the transport system. Again, part is why don't we create one special incubation center where these EVs can be set up, because I'm not pointing out to particular ones, because we as a financiers will only be benefited if the EVs which are coming out of this industry is properly being tested, and then put in the market. Like there are many incidents which has happened, and the impact finally happens. I think the impact also happens on the OEMs, but there is also an impact which happens on the financials as well. The customer is not paying my EMI, and that will help if we have some incubation center where we can check all the document properly, the BMS is working, where batteries are correct, and other things. And the major part is people will definitely going to buy if there is some regulations to promote the EVs. I think there are few regulations which is already there. Talking of the Delhi government, they have I think higher subsidies which will help them in going. But can the government support in waiving of an auto rickshaw permit and waiving of the parking fees for the electric vehicles, and then the registration charges, and that will help for more helping in. And last but not the least is the charging infrastructure, which is definitely will help in boosting the electric mobility in this place.
Right, sir. Absolutely. So, like you said, that as financer, you will be more comfortable if the OEMs, the vehicles that they are supplying are tested up to a standard. So, I'll come to Vani with that question. That as an OEM, Vani, what kind of assurances do you plan to give to the financiers as an OEM? That it's a new market, it's still in a nascent stage, and there have been some unfortunate experiences. So coming from all of that, what is the thought process at Euler Motors, how to put the financiers at ease while backing your vehicles?
Yeah, I mean, like Dhiraj mentioned, any unfortunate incident, it kind of spoils the whole sentiment against the industry. As an OEM, even if you go to sell a vehicle, people have burnt their fingers. In so many instances, it's really difficult to kind of reinstill that faith. So as an OEM, we provide various comforts to financiers, and I'm happy that we work with most people on this panel. They're already empaneled with Euler. So see, it's a very new technology. As an OEM, it is our responsibility to instill faith in financiers that yes, this can be financed, and the earnability will be to an extent that the repayments can happen. We have to provide them a lot of data. Everyone is getting data driven these days, so providing data actively in a form which can be very easily understood by the financier. So telemetry, of course, is available to everyone, but how do you present it in a way that financiers have the comfort? What would be the possibility of an NPA? Why would it be there? Because the vehicle is not running or the uptime is not there. Any preventive maintenance which we can perform basis the data which is available to us as an OEM to ensure uptime of the vehicle. We also provide geofencing. So if a financier is not comfortable with the vehicle running beyond a particular limit, the vehicle would not. We provide remote immobilization so that in case any EMIs have not been paid on time, the vehicle doesn't run till the EMI is paid. So as an OEM, we are trying to provide as much comfort as we can so that, and I'm very happy to see that financiers are now starting and have been supporting new age startups like us who are trying to make a mark in the EV ecosystem, because without their support, it would not be possible to sell vehicles, specifically to the retail customers. Like Nehal and Samir mentioned, they don't have a bank history or a credit history. And while today we have a lot of VC-backed startups procuring three-wheelers, if you see the ICE industry, traditionally this is not the case. And I'm sure tomorrow retail would dominate the market. So we have to set the precedents right as an ecosystem together to enable these retail customers so that their sales also pick up. Because if you see the traditional market, 80% of the sales would be retail sales. So EVs are yet to get there in terms of retail, but I'm sure with the support of the financing ecosystem, we will get there.
Okay. Yes, we will definitely, Vani. So thank you for that. Mr. Rajat, I will come to you next. So like Vani said that as OEMs, they are providing all these facilities for the financiers to collect data on and to keep a tab on the vehicles that you have financed, what they're performing, how they're performing, how much they're running. So that gives financiers a fair idea of what's happening with the investments that they've made. But I want to understand from you, in EVs, what is the approach towards dealing with defaults? Like, when do you say that a particular vehicle, a particular case, in case of a delay or a default, when do you say it's an NPA? And if you recover a vehicle, what after that? What is the plan for putting those vehicles back on the road?
So delay and delinquencies are part of the entire lending ecosystem. But in case of EV lending, as customer don't have banking habit, so delay and delinquencies are higher as compared to other products. As Mufin Group, we are dealing in all products, other unsecured loan products also. But in all those borrower segments, customers have banking habits. So the major problem is banking habits. As Nehal has already pointed out, that customer don't do banking, and in tier 2 and tier 3 cities, rural and semi-urban area, banking cost is very high for these segment of customers. They have to go to a bank, they have to be in the queue for depositing their money for 2-3 hours. That reduce their income of that particular day. So for me, if any EMIs is not collected within next 15-20 days, so that means that case is going to be in default for at least for next 6 months. So if he's paying his EMI after 20 days of due date, so he's going to miss his second EMI also.
Right.
So the continuous delay will happen in such cases. So to avoid defaults of EMIs, the main point is that we should develop banking habits to customers. We should avoid collecting cash. We can explore other options like implementing QR-based payment for our borrower, which will bring that money into his bank account. From there, he can pay EMIs. We can promote by waiving late payment charges in case of payment within next 2 to 3 days from due date. We can give him some sort of concession in interest rate if he clears all his EMIs through bank accounts, which will ultimately going to reduce our cost also because of heavy cash collection cost at the part of NBFC. So for me, for our organization as Mufin, we try to collect all EMIs within 5 working days from due date, and we are encouraging our customer to take new age technology advantage for increasing banking habits.
Okay, sir. Understood. Mr. Ashok Mittal, I'll come to you next. So, sir, I want to understand from you, when we talk about cargo fleet owners versus individual clients. So what is your approach towards financing these two categories, and how does that approach differs?
Sure. I think quite an important and a different kind of question this is. So first of all, let us understand the cargo fleet owners or cargo operators versus individuals. Somewhere they are interlinked as well, because most of the individuals who are operating these cargo vehicles, they also have some relationship with some fleet owners, and the percentage of people who are operating these vehicles independently without getting associated with any fleet owner are quite less. However, I noted certain points based on the question and which any leasing company or financing company will look at, right? And based on that, of course, each company have their own approach in terms of whether they want to do large ticket wholesale lending or they want to do small ticket retail lending like us. So we at PrestLoans normally prefer a small ticket loans. So hence our focus is on that. But nevertheless, if you look at both the points, and in one slide, Nehal also mentioned a comparison between a corporate and the retail, right? But here I would like to say from pure lending perspective, how does it look to us at PrestLoans? One, if you're financing to the fleet owners, cargo operators, then your ticket size requirement is larger because they would look for a larger sum of investment amount, loan amount versus the individuals. So individual, generally you will fund one vehicle to each individual. So the cost will be between say 2 to 5 lakh rupees, even if you go for a high-end L5 vehicle. So one larger impact is that your amount of financing to single entity and also the ticket size for each entity. Second, you have to look at the leverage, what kind of leverage these people are going to take. So far in this industry, especially in the EV industry, at least I have experienced that most of the cargo operators, fleet owners are new to the segment. So they are, let's say, tech-driven companies. So their capital size is not really huge, even if they are funded. So if you look from absolute traditional financing perspective, you will not find their balance sheet very attractive to finance, right? Whereas when you finance to an individual, and like Nehal and Samir has shared, most of these people are new to credit, right? They don't have a credit history. So you can say that they are not leveraged. They have not really taken many loans. Maybe they are not eligible, etc. But actually, you don't see a lot of liability on them. So you find them, their leverage is quite less. Third comparison, we look at the skewness. So most of these fleet owners have 2 or 3 very large clients to whom they are servicing. Okay, they are those typical e-commerce companies. So their skewness to the customer, to their customers to whom they are servicing is very high. Versus when you do for individual, they are running on the same platform, right? So even if they are associated with one particular operator, say fleet owner, they can move to another one quickly, right? So nowadays we have seen even normal car, they are empaneled with Uber also. They are same person is with Ola also, right? Similarly, they can get associated with multiple fleet owners, whereas the fleet owner it will not be able to move to multiple large companies quickly. Of course, there is one very important point which Nehal has raised, which I also wrote, that in terms of their understanding, technology, use of banking, knowledge is quite high for a cargo operator. Whereas this guy is generally in normal language, a poor guy, he does not understand. But what I really know is that he understands the business. He runs his business and he is doing this for his bread and butter, for earning. So he understands to that extent that, okay, I am taking this loan and I need to pay this much EMI. And when you talk to them individually, they will even talk about 1 rupee, 2 rupee, 5 rupees. So they are quite sensitive to this, right? So they understand the business. Now, if you look at the agreements or contracts the cargo operators have with large FMCG companies or e-commerce companies, if you really go ill, there is in a way there is no guarantee, right? No guarantee, no surety. They do not give you guarantee as, to the lender, and it is just an agreement they have. So you have to bank on that agreement. Okay, at the most you can do escrow, not beyond that, right? So you don't really get a surety or guarantee from them in terms of performance of loan. Whereas when you give a loan to an individual, to some extent, either OEM, like it was mentioned earlier, so to some extent to OEM or the dealer or to whomsoever they are servicing, they might give you some kind of a guarantee. It may be buyback, it may be fixed rate, it may be some risk sharing, co-lending, whatever, right? But there is some kind of surety which e-commerce players are normally not giving to the fleet owners or operators. So there is a lot of dependency you have on them. In other case, when you give the loans to individual, you may even ask them to give a guarantor who is maybe a family member or an external person. So it makes you a little more comfortable, secure, safety from that perspective. Another important point which we look as a lender is on what basis you are giving loan, right? Of course, you look at the balance sheet, etc. But I feel that balance sheet will not give you enough comfort. So you are giving based on the agreement which they have with the e-commerce players, right? Here, when you give to individual driver come owner, then your basis is cash flow. So you look at, okay, how much money he will generate by driving the vehicle and what is his cost of operations, what is his cost. And that analysis was also given when he's earning, let's say, around 2.5 times more than what he's earning otherwise. Then the basis of giving loan is actually cash flow, right? Another thing is that if you look at the geography, how they are spread out. So most of the fleet owners or operators, you'll find Delhi, NCR, Bangalore, maybe 2-3 larger metro cities. Whereas these other people, especially the three-wheeler passenger vehicles, okay, this question is on cargo, but passenger, they are in tier 2, tier 3, tier 4 cities, right? So you find this challenge, which everybody has mentioned, cash collection, low understanding of the financial markets, but then they are spread out across the country, right? So your dependence on metros is quite high in case of wholesale loan which you to the dealers. And we have learned this from COVID that you should really not be skewed to certain cities, especially the metro cities. So we have actually, we were also operating in Delhi NCR largely till last year, till COVID time. And then we decided to move out of Delhi NCR, do business in smaller cities. That was a learning which we had. And last but the least point which I can talk, which every lender looks at, is the ROI which you get. So of course, your commercials are very, very competitive in wholesale market versus what you do in the retail segment. So I'm not saying that, okay, fleet owners or wholesale lending or when you do is not advisable, not doable. Of course, it is doable and people do that. But these are the, let's say, comparative things which we look at in terms of risk, then risk-weighted returns, what kind of returns we will get. And of course, our first choice is always give loan to the individuals who are Tribe-cum owners. There is also one philosophical point that you are really helping those individuals to earn better and make some change in their life, which is non-commercial factors. Thank you. Oh, you are mute.
Oh, sorry. Yes. Thank you, sir, for drawing out that comparison so nicely. Thank you. Nehal, so going forward, like this is, we talked about what the ecosystem looks like today. Going forward, we are anticipating some changes. For example, the battery swapping policy will kick in at some point, hopefully this year. And so particularly with respect to battery swapping, do you anticipate any changes in leasing or financing when the policy kicks in?
See, I think where battery swapping kicks in as a model is to reduce the upfront cost of an EV. So currently my EV, the constitution of a battery is about 40% of the cost for the vehicle, right? So if that is switched to battery swapping, then you're essentially using battery as fuel. You don't have a fixed battery sitting in your vehicle, which definitely reduces the upfront cost of the vehicle, which will then in turn make it makes it cheaper for the customer to procure that vehicle. Right now the customer's down payment for an L5 vehicle can go as high as 40, 50 to 60,000 rupees because of how lenders want to cap their risk at a certain price. Like if an L3 vehicle is, say, for example, 1,50,000, then you would cap the loan at 1 lakh. Most of the lenders are doing that. And for L5, you would cap it at, say, 3 lakhs because the vehicle can cost up to 4,50,000 also with all the fully loaded vehicle, right? So reducing the battery cost out of these fixed costs can definitely help in the increased adoption of the vehicles, and then treating the battery separately, which would also help regularize the battery market. Currently, we are financing battery with the vehicle, right? The battery is inserted in the vehicle and we are financing it as a package. Once the battery is taken out of the vehicle and is treated separately, then you have different battery leasing, battery financing, battery refinancing schemes. And the existing models you have for vehicles just become 30 to 40% cheaper. So now a vehicle that costs about 1,50,000 would end up costing about 1 lakh, maybe 1 lakh or 20 lakh. And then the LTV you offer on that 1,20,000 will significantly be higher than the LTV you're able to offer on the 1,50,000 rupee loan. So definitely swapping that way will reduce the upfront cost and will also regularize the battery leasing and battery financing market and what to do with the battery post the tenure of the vehicle. So currently in fixed battery models, now if I'm, say, lending to an Euler vehicle, which is about, say, 36 months, because the 36 is capped because of the warranty and guarantee of the battery that you get. That post 3 years, the company takes off the responsibilities of the batteries, right? So what happens to the battery post 36 months? We don't know. Can you refinance that battery? Can you refurbish that battery? Can the cells change within the battery and be reused with like a lesser range? So there are these questions which are not resolved yet because no one has experienced dealing with those batteries post the tenure of 36 months. We've seen those vehicles maybe run 12 months, 15 months, 24 months on the road, but not complete 36 months. So to evaluate the condition of the battery, what number of cycles they can take, how many kilometers can it run post the tenure, those questions can definitely be answered if it goes into the swapping model, where there are different stakeholders taking care of the battery and different stakeholders taking care of the vehicle. So definitely, I think that way it would help regularize the leasing for battery market and then reduce the upfront cost of the vehicle itself.
Okay.
Yeah.
Okay. Right. Thanks, Nehal. So, Vani, like battery has always been at the very heart of any discussion around electric vehicles, and I'm sure you get this a lot. But I would like to understand from you, how would, as a OEM, you deal with a situation where the battery or the cells need replacement, if, and if during the warranty, or maybe or during the tenure of the loan, that situation comes where the battery or the cells get damaged and you ultimately need to replace the battery. So how are those situations handled? How do you prepare for issues like that?
Sure, this is a very common question we get. So Euler is one of the OEMs which offers an extendable warranty of +2 years on the complete vehicle along with the battery. And like I mentioned earlier, the AMC package does offer a buyback on the vehicle as well. So with a combined combination of these two, it kind of alleviates the risks on the battery, because we're saying that we're extending it from 36 months to 60 months, and we're kind of ensuring that the range would be maintained. However, of course, if there is a technical issue in the warranty, then if there's a technical issue in the battery which is affecting the performance of the vehicle, then the warranty covers it. We haven't seen any issues so far, so too soon to comment, but we have given the comforts there that as an OEM we will take onus to it. In addition to this, I would like to specifically mention some of the innovations which Euler has done with respect to the battery pack. So our battery pack is IP65. It's 12.4 kilowatt hour, which is the highest in the industry, to ensure that range is not a concern for the driver, and the range anxiety doesn't exist, or at least alleviated to the extent possible. Other than this, of course, we have liquid cooled technology, which is we are the only three-wheeler offering this, which it kind of helps us ensure that there's no thermal runaway, because we are ensuring that the lithium-ion cells are operating at a particular temperature, and we are monitoring that. So it not only helps you safeguard against mishaps, but it also helps you increase the longevity of the battery pack, because India being a tropical country, the degradation is so high because of the high temperature. The ambient is so high, so the temperature in the battery is just inside the battery would be not safe to operate also. Right. So these are some of the things as an OEM which we are working around on the battery front. To give comfort to the customer, to the financiers, and the whole ecosystem in general.
Okay. Thanks, Vani. Mr. Dhiraj Agrawal. So if we've seen that recently Mr. Nitin Gadkari made a statement that all the alternative fuel sectors should come under priority sector lending. And we discussed that Nehal also mentioned that it's very close. It might be close where RBI will bring it under priority sector. So how will it change? How will it help reduce the cost of lending for the NBFCs and for the banks? Basically, once we say that it comes under priority sector lending, what then? How will it help?
I think this also is some part is already been covered by Nehal's presentation. Yeah, but I will still want to cover some of the things. The good part is, there is a lot of buzz in the market for coming this in the priority sector lending. The two things will definitely going to happen because now banks want to start the EV financing, and we all NBFCs are already in this business. So one thing will definitely going to help is why don't these banks will start co-lending with all these NBFCs. So NBFCs will start getting the money at a cheaper rate. So that will incentivize NBFCs, as well as that we can include that in the co-lending part. And another is for a good part from the NBFC side, they are going to get the money at a very cheaper rate. That will also boost the business. Since all NBFCs are struggling for the funds, so they will get money at a very cheaper rate. And the other part, customers will also be benefited because they are also benefited of getting the vehicle at a very cost conscious rate. Very recently, today there is an article that CESL has tied up with Three Wheelers United for 70,000 vehicles which they are coming in. So CESL again is the government organization, and they are coming in a big way. So that will also boost this industry.
Okay, sir. Thank you. I'll come to Mr. Rajat Goyal for the next question. Sir, first of all, we would like to know what is at present Mufin's scale of operations in the EV financing space. And the other question is, I think it was missed earlier. How do you put a recovered vehicle? What do you do with the recovered vehicle? How, because the secondary market, as we say, is still evolving. So do you have any, any tie-ups with the fleet operators? How do you put it back on the road? Sir, you're on mute.
Sorry.
Yeah.
So at Mufin, we have disbursed so far around 12,000 plus electric vehicles. And in last 3 months, our monthly disbursement is at the range of 1,000 to 1,200 vehicles per month. So we are increasing our footprints in other geographical parts of India also, including east and southern part of India. So we do two-wheeler, three-wheeler and four-wheeler, all three types of vehicles we are funding right now. Apart from that, we are funding charging infrastructure and swappable battery stations also.
Mm-hmm.
So as far as repossessed vehicles and redeployment is concerned, so as there is no formal market, there is no setup is available where we can sell it. We are largely dependent on our dealer network and our sales team, either resell these vehicles or refinance these vehicles. So we are open to refinance repossessed vehicles so that the new customer also get benefit of reduced price. And in all our agreement with all OEMs, we prefer to have a clause for refurbishment of repossessed vehicles so that its value and its life both enhance. So for any new customer who is buying a used vehicle, he is getting, I would like to add one more thing. So primarily the position of repossessing a vehicle comes within first year of loan itself. Post 1 year, there is hardly any case where we need to repossess the vehicle. Okay. So if in 6 or 9, say for hypothetically, for example, if I repossess a vehicle in 9 months time and my OEM support me for refurbishment of that vehicle, I can get the maximum price for that vehicle. And my new customer is also satisfied because that vehicle runs as good as a new vehicle. Mm-hmm. My dealer is benefited from, he is getting his sales commission on helping me in reselling that vehicle, and I am refinancing that vehicle more than my means I am getting my all money along with interest on further EMIs. So this is what we are doing right now, and we are expecting the formal channel for reselling and refinancing of repossessed vehicle or used electric vehicles will definitely come up very soon. So as of now, in case of two-wheeler and four-wheeler, market is available, players are available there. But in case of three-wheeler, there is no such marketplace to handle repossessed or second used vehicles.
Okay, sir. Thank you so much. Mr. Ashok, I'll come to you next. So what we've seen is, at least it is my observation, I may be wrong, but what I have observed is that with respect to three-wheeler financing, there is still dialogue and a lot of players are coming in to do that. But for two-wheelers, electric two-wheelers, it hasn't taken off as much. What do you think is the reason? Is the reason the mere volumes or overall penetration in the particular vehicle segment or something else?
So as far as three-wheelers are concerned, and that too in three-wheeler, you will see more of passenger vehicles being driven, right? So of course, that market is in highly populated, dense market, which is Uttar Pradesh, Bihar, Odisha, West Bengal, etc. The penetration in other states for even three-wheeler is quite less. When you go to two-wheeler, so you will find that most of the manufacturers are at low-speed two-wheeler market, which is not registered. Yes. So when the vehicle is not registered, then the hypothecation cannot be created. So a lot of people who look at, let's say somebody looking to finance a auto or a two-wheeler or bike, he would look at a hypothecation with the RC being having their name, insurance policy having their name, etc., which is not there in this case. So if it is not there, then it is a normal, say, unsecured loan or personal loan, or you can call it a consumer loan. Hence, that additional security which otherwise available is not there. The other two-wheeler is a high-speed bike, which is a high-speed vehicle which can be insured in your name. You can have your name. You have hypothecation in your name. So as far as my experience is, those vehicles are largely driven by these fleet operators or service providers who are giving deliveries to food tech companies, etc. So those are running on lease model, where these companies who are aggregators or managing vehicles, they generally buy vehicles in their name, and then they give onward. They also take on lease, in fact, and then they also give to the drivers or users on onward lease, or they have drivers who are their employees, you can say, right? So this is the main reason. Then you look at it. Thirdly, maybe when you look at the numbers, whether it is count or amount. So since the value is lesser, so obviously the amount wise it will look lesser, right? I feel this is the reason.
Okay, sir. Understood. So I'm just checking time. So I think we have just enough time for the Q&A. So before we move on to Q&A, if any of the panelists wants to make any comments, you are welcome to do that. And after that, we will start going through the questions, the audience questions.
I think I'm okay to proceed to the questions.
Okay. Just give me 1 second. So I see that some of the questions that have been asked have been covered either during the presentations or in the individual speaking slots, but I'll still quickly go through a couple of questions. And as panelists, please feel free to pick any particular questions from the Q&A box if you want to. I'm having a little bit of trouble with my Q&A box. Just give me 1 second.
There is one point somebody asked for e-cycles. So for financing and all, I guess. So more or less his answer gets covered what I spoke about low speed bikes, because they are not registered. So obviously their underwriting method is quite different than what you look at a three-wheeler or a registered bike. So anybody who would look at financing the e-cycles would also look them as an unsecured loan or a consumer loan. Hence the underwriting would be based on this kind of loan. So if they are a manufacturer or a service provider and somewhere are looking to get financed their e-cycles, then they will have to make these kind of arrangements with the financer, that how they provide some kind of security.
Yes, I think that question I think was from Nexu Mobility. They provide electric bicycles. Yes.
Yeah, so that's what I want to just add to what Ashok sir wants to explain. Yeah, through e-cycles, or there are some questions on the charging platform as well. So actually, these are all basically an unsecured. So if you want that, just tied up with any NBFC, and we can do it for any personal loans way forward. There are many platforms available. We can do it. There are many people doing it.
Right. Yes, you're right, sir. Two-wheeler loans are actually being dispersed as personal loans.
Yeah, non-registered.
Yes, the low-speed two-wheelers.
Yeah.
Yes, sir. Okay. So, Nehal, there is one question for you specifically from Jinesh Gandhi, and they're asking, how do you underwrite risk of technological changes and its implication on the resale value? Also, considering the trend of falling battery prices, how do you judge resale value considering battery cost is a huge part of the vehicle cost? Any comments?
Yeah, I'll try to answer the question. So how do you underwrite risk of technological changes? One thing like we talked about is getting assurances from the OEMs. So if it is a new technology, it is a nascent technology that as a lender, I'm not too aware of, then post the tenure of my financing, if the OEM is agreeing to buy back the batteries, for example, or buy back the vehicle, for example, then I don't have to worry about keeping that asset on my books and incurring the costs that come with it. So I think having that assurance from an OEM definitely helps in my underwriting risk, because I would also only finance to those OEMs that have a proven track record in that technology in supporting the stakeholders they're currently partnering with. If we deal with an OEM that does not support you with services, that does not support you with aftermarket services, or the support through the lifetime of the vehicle, then it is a problem. It is a challenge for the finances, because where am I going to go find someone as an NBFC who can buy the batteries after the tenure? So definitely support from OEMs is a big one there. And the second
Okay, so
Sorry,
you can
yeah.
put to answer tab and
And considering the trend of falling battery prices, how do you judge the resale value? Again, as a lender, I have no mechanism currently to judge the resale value. I go by what the OEM tells me or the OEM's technical manual tells me, that it can run 80,000 cycles for 3 years. Beyond that, even we don't know what is going to happen. Will the cell, given how Vani was mentioning that India is a tropical country, we don't know how it reacts with the weather, how it performs with the weather. And it also depends on the conditions of the vehicle, how the driver is driving the vehicle, at what speed is he driving, at what payload is he driving consistently, which impacts the performance of the vehicle. Like if Vani, you can back me up here. So I think the falling battery prices is not an issue because any asset depreciates with time. But judging the resale value, again, I would require OEMs intervention or secondary market players interventions as and when they grow to help me judge what are the parameters and metrics I should judge the resale value on of the battery.
okay, thanks.
Yeah.
I think Nehal has covered all the aspects, and like she earlier also mentioned, no one in the industry has seen the full life cycle of a product. So even as OEMs, we know we would have to work towards building the secondary market, but it's just too soon to comment on that as of now.
Yeah.
Okay, understood. So Mr. Sanjeev Agrawal has asked a very straight 3 questions. What is the average ticket size of the loan? What is the interest rate? And what percentage of the vehicle value of the vehicle is financed? So if do we have any average range or numbers to answer these questions? For let's say we can talk about maybe L3. For the L3 vehicle, what is the average ticket size of the loan? And maybe for the L5 vehicle, what is the average ticket size of the loan?
Sorry, Mr. Rajat, please go ahead.
So average ticket size and LTV, on an average, 80% is LTV, but all of us financed in normal situations. So LTV and average loan size is a comparative thing. So 80% of on-road price we finance.
Okay.
And as far as interest rates are concerned, in case of L3 vehicle, it ranges from 15% to 18%.
15 to 18%. Okay. Thank you. Will it be
sorry,
yes,
there is
go ahead, sir.
sorry, so not this, but there is an additional point which has not got covered, and I thought it is appropriate because you are going to maybe circulate this to a lot of agencies as well. The insurance cost of these vehicles is extremely high.
Okay.
So this is a burden on the buyers when they buy an electrical vehicle. And if you talk to insurance companies, they would say that this is a new segment, this is a risky segment, hence the insurance premium is high. And if the 1 year premium is in the range of somewhere around 5 to 7%, which is extremely high, I guess. And there is a need to communicate this to the insurance company that they need to relook at it. Now, of course, we keep saying this is a niche segment, new segment, but this is not so new. We are around 5-6 years old in this segment, and you can look at how much damage would have happened, how much claims would have come to them. And I think this is something which really need to look at from the industry perspective, because whether you finance or you don't finance, but every year the insurance has to be taken, right? Yes. And if you're going to charge 5, 6, 7 percentage point per annum, that is too high for any user, especially when you are catering to low income group and where the premiums have to be justified. I don't see that the claim ratio is extremely high, so they need to keep the premium so high. So maybe this need to be discussed in detail and maybe on a separate platform as well, and need to be communicated, I guess.
Going off of that, I actually had another comment that like Mr. Mittal mentioned, the insurance price, even the RTO charges are still very much prevalent. You would hear the government saying they've been retracted and it's nil and it's exempted from, but call it over the table, under the table, whatever it may be, the customer does end up paying more than 15,000 rupees out of their pocket to be able to get their vehicles registered. So that is a huge cost. If you compare it with IC vehicles, it's almost the same. So there's no exemption given there, even though the government has claimed exemptions in that market. And with high insurance costs, margin money or down payment, and your RTO charges, their out-of-pocket expenses, especially in an L5 vehicle, becomes about 40 to 50K, which is extremely high for a retail customer. which is why the adoption of L5 vehicles in the retail market has been a very big challenge. So if we're able to actually exempt the RTO, take that money out of their expenses, I think it's going to become much more affordable, and lenders would be much more comfortable financing on road prices versus ex-showroom prices.
True.
Very good point. Yeah. Thank you. I would also request all the panel members to share their teams, because there are a lot of comments from people asking to get in touch with different companies you are representing. So if you can share your teams or your general email address or a sales phone number where people can get in touch, you can do that over chat. And there are multiple requests for phone numbers and email addresses. So that would be great.
So I could see the chat. There is our team members are there and they have sent messages. Mr. Ashish Singh. So if he's there, he can. I think he share his name, number, and email ID, etc. So
yes,
contact.
We have PrestLoans email address and phone number on the chat.
I think Mr. Manish Sinha from my team has also given email addresses and phone numbers. I think it's it is there, yeah.
I guess most of us are available on social media. Anybody can.
You can stalk us on LinkedIn, yes.
Yeah.
All right. So I think we are almost, it's almost 4:30. Any last comments from any of the panelists? And after that, we can wrap up the session.
There is one small point which was there in my mind.
Yes, sir.
There was a discussion on PSL, that if the priority sector lending happens, then so although like anybody else, I will welcome that, but I also have a very strong belief that this particular segment in itself is very bullish. So whether there is any discount, no discount, concession, no concession, any subvention, no subvention, PSL or no PSL. So the market grows based on the how feasible it is for people to operate that particular segment. The kind of benefits which Samir also shared and Nehal shared in their presentations. Of course, they are in a way commonly known things, but they have specifically mentioned, right, what kind of savings you do, how it is really helping. It is creating a lot bigger social cause in the country. So I guess this will grow irrespective of anything available or not available. It has already been growing, right? Like we say, if the rate of interest is higher, LTV is lower, RTO fees is higher, insurance is higher, still it is growing, right? So it has to grow, it will grow. So people should not really look for too many things that if this happens, then only this will grow. It will grow. So I guess the people who are into this ecosystem, whether they are starting from the drivers to the financer, OEMs, they are creating a huge change in the country. So this is the segment which is going to be there. This will be the segment.
Yes, right. So what we mean was that the things like priority sector lending will sort of accelerate it a little faster than the organic speed it will take.
Somebody has 40% month-on-month growth.
Sorry, sir.
Right. 40% month-on-month growth.
Yeah.
What else you want acceleration? I agree. I'm not saying it will not happen.
Right.
But I'm saying irrespective of the fact.
Irrespective of the fact. Right.
Yeah.
Right. Absolutely. So I would just once again thank all the panel members for taking their valuable time for this event, and all the participants for listening in, asking good questions, and making time for this. We will be uploading the recording of the video on our YouTube channel by the end of this week. So if anybody wants to revisit Nehal's or Samir's presentations or the Q&A or the panel discussion, they will be able to do so. Thank you so much, everyone, for your time, and have a wonderful rest of the day.
Very much.